Let's now solve consolidation question from May 2024 RTP. This question doesn't want us to prepare complete consolidated financial statements, but it is on computation of a very small part. Computation of cost of control, evaluating goodwill or capital reserve arising in that particular situation. Read. Zoom Limited acquired 70% of the shares of Star Limited at rupees 30 per share. 30 is purchase price, not nominal value. So how many percentage shares do we hold? 70%. And Zoom Limited is the holding company, Star Limited is the subsidiary company. So what do? I would have to analyze the reserves, analyze the capital of Star Limited, which is my subsidiary. How much do I hold in this Zoom Limited, the holding company? I hold 70% shares. 70%, how many shares do I hold? I don't know. I own 17. So minority will be having 30% in it. Right now, I don't know the total share capital. I don't know number of shares I hold. I don't know nominal value I hold. But I know the price. What is the price that I pay? 30. But this has to be multiplied with number of shares that I buy. I don't know that. So I can't find book value of investment. I would wait. Continue reading. Following is the extract of balance sheet of Star Limited. Star Limited had 15 lakh equity shares of rupees 10 each coming to 1 crore 50 lakh. So what is the share capital of Star Limited? 15 lakh equity shares of rupees 10 each, 1 crore 50 lakh. 1 crore 50 lakh. So I hold 70%. How much is 70% of 15 lakh? I hold 10 lakh 50,000 shares. I can make this 15 lakh. I hold 10 lakh 50,000 shares. 10 lakh 50,000 shares at rupees 10 each. Can I say it comes to 1 crore 5 lakh? So the nominal value of the investment is 1 crore 5 lakh. Let me write here, nominal value of investment is 1 crore 5 lakh. This is the liability in the books of the subsidiary company. I can also find the book value of investments. How do I do this? Very simple. We purchased each share at rupees 30. Now we know that number of shares that I purchased is 10 lakh 50. To 10 lakh 50,000 shares into 30 rupees per share, I will get 3 crore 15 lakhs to be my book value of investment. I'm writing this in the inner column because I need to adjust this with the reserves, which is pre-acquisition nature to the extent it is holding company's share. Understood? What's after this? They've given debentures, ignore. They've given trade payables, ignore. Property, plant and equipment, ignore. Investment, ignore. Current assets, ignore. Loans and advances, ignore. It's of no use for us right now in computation of cost of control. Now, see, they've asked us to calculate only goodwill or capital reserve. See, they've not used the word cost of control. They've told compute goodwill or that will arise in cost of control. Okay. So we don't need all of this information, but we would actually need it. I'll tell you why would we need it later. Read. On the same day, Star Limited declared a dividend at 20%. See, on the same day in the sense, same day when we acquired. They are using the word here, extract of balance sheet when we acquired 70%. And they're telling on the same day dividend is declared at 20%. That 20% dividend, whatever is declared, is pre-acquisition in nature. Such pre-acquisition dividend, you remember AS13, it will decrease the cost of investments. It will be reduction from our book value of investment. So book value of investments have written 3 crore 15. From this, I would deduct pre-acquisition dividend that I'll receive. How much is pre-acquisition dividend? 20%. 20% of nominal value 10. 2. 20% of nominal value 10 is 2. You can do 1 crore 5 lakh into 20%. Or you do 10 lakh 50,000 shares into 10 into 2. Sorry, into 10 into 20%. Or you do 10 lakh 50,000 shares into 2. You can do it anyway. Each share 2 rupees dividend. Nominal value 10. Dividend rate 20%. For each share, how much dividend do we get? 2 rupees. For 10 lakh 50,000 shares, how much do we get? 21 lakh has to be deducted. Now, please don't deduct 3 crore 15 minus 21 and write it in the outer column. Wait. Why? We need to still adjust pre-acquisition reserves if any. Am I right? Continue the question. They are telling as agreed between both the companies. Okay, that ends here. There should be a full stop here, which is missing. Property, plant and equipment were to be depreciated at 10% and investments to be taken at market value of 9 lakh. So when we do this, no, it will affect our reserves. Am I right? Yes. The most interesting part is in the question there is no reserves available. You should have given reserves, which you are supposed to split pre and post. Oh my god, what do I do now? Simple. This is the balance sheet extract. We have everything else other than reserves. Identify reserves as balancing figure. Here I'll teach you a beautiful shortcut. Now when you prepare balance sheet for these items, you will get reserve on the date of acquisition. Then you would have to adjust this property depreciation and then market value separately again. Again, that will be free. Do one thing, no. Straight away adjust this PPE and then investment to this only and then prepare balance sheet. In that balance sheet, the missing figure is reserves. That itself is your pre-acquisition reserve. In that you identify your 70% and then deduct it from book value. This is what you should do. I'll repeat. They've given data which looks like balance sheet but not balance sheet. So in the absence of specific mention about reserve, we have only one way out. Only thing missing in the extract is reserve. So using the data, we'll prepare a balance sheet to find reserves as balancing figure. But that reserve will be on the date of acquisition. We need to further identify this PPE revaluation and investment revaluation difference as reserve. To that reserve, what we find in the balance sheet, we should add these items and that should be shared to holding and minority. Instead, what I will do is when I'm drafting balance sheet using this data, I will revise the values of property, plant and equipment and investment. Then whatever reserve comes, no, that is the reserve. Did you understand? So this is the approach that I am following. Do they do the same in the ICA study material? No, they have not done this. You know what have they done? They have not taken this nominal value of investment 1 crore 5 lakh here. They have not taken. What they do is they add all the assets, deduct all the liabilities other than capital. Other than capital in the sense missing items is capital and reserve. They find reserve and capital together as one item. That they've shared 70% to holding, calling it net asset. But you know what is happening by that? This I'll write asset here, no, sorry, 1 crore 5 lakh equity capital here nominal value. And that pre-acquisition reserve, I am deducting from this. So what they do is this deduction, they'll send it to this side. So they'll add it to nominal value. So it will become share capital plus reserves multiplied by percentage. Only thing is, instead of deducting this from book value, they've added it to nominal value. And they've given new name to nominal value. Net asset value of the share of holding. That's a new name given. But don't worry, answer is same at the end. And cost of control, how to compute goodwill or capital reserve is told in AS 21. It doesn't give the format using which you should compute goodwill or capital reserve. So what they have done in the material is correct. What we have done or what we will do will also be absolutely correct. Shall we prepare a balance sheet now? This is after declaration of dividend. And what is the objective of preparing this balance sheet? Determining reserves. Shall we do this? First item, 15 lakh equity shares of 10 each, 1 crore 50. 15 lakh shares of rupees 10 each, 1 crore 50. Understood this? Next, reserves, which we don't know, which we will find. Then, debentures. How much is debentures? 15 lakh. I'll write 15% debentures, 15 lakh. Then, trade payables, 82 lakh 50. Liability, I'll write trade payables, 82 lakh 50. Then, property, plant and equipment, 1 crore 5 lakh. They have asked us to charge depreciation on this at 10%. So on the asset side, I'll write PPE 1 crore 5 lakh plus depreciation on PPE at 10%, which is 10 lakh 50. If I deduct this, I'll get 94 lakh 50. Everyone understood? After this, I have investments. Investment is 6750. There is an adjustment which says that investment should be valued at 90 lakh. Let me take that. I'll write investment 6750, but that will be taken to the outer column at 90. To do that, we are going to do revaluation upwards of 22 lakh 50. I don't have to worry. The moment asset increases here, no, reserve increases automatically here. If not, I was supposed to take without this revaluation. If I would have taken 6750 here, if I would have taken 1 crore 50 here, 1 crore 5 here, I would have got reserves before this adjustment. From that reserve, I was supposed to deduct this depreciation, add this revaluation to find capital reserve. Now it is simple. You will find once for all reserve after including every adjustment to investment and PPE. Then we have current assets 1 crore 2, which has no adjustment. So I'll write current assets 1 crore 2 lakh here. Then I have loans and advances 33 lakh. I'll write here loans and advances 33 lakh. Everyone's got this? Now check the total on the asset side first. 9450 plus 90 plus 1 crore 2 plus 33 lakh. 3 crore 19 lakh 50. Right, 3 crore 19 lakh 50 here and then deduct these three items to identify balancing figure. 72 lakh is the reserves and surplus which I found as balancing figure. This 72 lakh belongs to subsidiary company. I have only a stake in it, not 100% subsidiary. How much stake do I have? 70% as mentioned in the question. So take 70% of that reserves. 50 lakh. This is our pre-acquisition reserve which should be deducted from the book value of investment. Please do 3 crore 15 lakh minus 21 lakh minus 50 lakh 40,000. 2 crore 43 lakh 60 is asset. Which is more? Asset is more. So the resulting number is goodwill. 1 crore 38 lakh 60,000 is the answer. So this is how we've computed it. This is our first note for computing stakeholders percentage by holding and minority. Then cost of control, which got completed only after I determined reserves using a balance sheet that we prepared here. This working note is done differently in the ICA module, and this 50 lakh 40, instead of deducting from 3 crore 15, they've added this 50 lakh 40 to 1 crore 5 lakh, and they've not added separately. They've written it as total amount once for all. Understood? Same working note, they don't write 1 crore 50. So here you get 2 crore 22 lakh. In 2 crore 22 lakh, they'll take 70% and then write it here as liability. That's the only difference. Understood?